All right. Ladies and gentlemen, welcome to another episode of Marketing Management and Money. I'm your host, Ryan Owens. Here with me is Ryan Murray, and we are going to be looking at an incredibly nerdy topic today.
An incredibly beautiful topic today.
You're going to revel in. And we're excited to learn about. We're learning about the working capital cycle.
So, for all the listeners who didn't automatically shut off as soon as they're like, wah.
Skip. Can't find that fast forward back.
All those marketing episodes, those are cool. Give me the marketing ones.
Yeah.
Which is so true, because you get to finance and you're just like, oh, I don't want to do the finance, but you got to do the finance.
Yeah, it's like saving receipts is bad enough.
Yeah. But honestly, if you want to be successful, if you want to grow your company, finance is the language of business.
Yep.
You got to learn it. And so we're going to talk about the working capital cycle.
Yeah, no, that's cool.
So, super popular topic. Everyone knows what the working capital cycle is.
In finance.
In my realm.
Yeah. In the real world. Let's explain it quite gently for those who are not of...
Now there are probably quite a few
lineage.
listeners out there who have heard about the working capital cycle. I find when I do trainings and seminars that there are a lot of people who have heard about this,
Sure.
not so many people who actually know how to do anything with it. And there's like,
Right.
oh yeah, you take your current assets and subtract out your current liabilities, right?
Yeah.
Like that's...
I'm sure that
That's
there's
it.
definitely a large percentage of people that do that.
And you know, and then I love the ones that are just like, oh yeah, working capital cycle. That's just like how much capital you have.
Yeah. No.
So
as I so eloquently phrased it earlier, and you corrected me quite abruptly, it's how long it takes your money, aka your cash, to get back to you.
yeah.
Not your green regular money,
And
but cash.
yeah, we've had this conversation several times,
Yeah.
and yes, in a previous episode, I did kind of hound you on that.
Yeah.
But thank you for the clarification. We're talking about cash, and if you've done your working capital cycle correctly, what it's going to tell you is it's going to tell you how many days it takes that cash to cycle through your business.
Yeah.
So let's start with, why does that even matter? Why do we care how long it takes cash to cycle through a business?
Sure. So it's like the amount of money you have to have in order to keep your business alive.
Yeah.
Right? Like if you throw some cash out there and you don't have cash in your reserves and it goes out to pay for some inventory, and then it takes you another 3 months to sell that inventory, and then you give 90-day terms, all of a sudden you're looking at a really long time before you get paid that cash back. And if you don't have the money to float your business for that amount of time that your cash is out there, not in your hands, you're done for, mate.
Yeah. And I even want to go with a simpler definition right off the bat. I mean,
Sure.
that was beautiful where you talked about, look, this is what we're looking at in terms of time of your cash being out there. But I want to go simple for a second.
Okay.
So I can have a situation in my business where, you know, sales are down, or I could even not have sales come in for a period of time. There are a lot of businesses that they're seasonal, and they might not have sales for a period of time. You know, if I'm a ski resort, I probably don't have a lot of sales coming in July, right?
Right.
And so I can have, you know, low profits, no profits, negative profits. I can still be in business. The second I run out of cash, I'm done. And that is one of the things, if you get nothing else out of this episode, know that when you run out of cash, you are done. Your business is over. When people shut the doors, they don't shut the doors because they ran out of sales, because they ran out of profits. They shut the doors because they ran out of cash.
Yeah.
Say it correctly.
Well,
Now,
and we've talked about how you can go out of business with record sales.
oh yeah,
And it's
yeah.
if you run out of cash, right?
It's the cash, and that's why they say cash is king. That's really what they're getting at.
Yeah, right. Exactly.
And so the working capital cycle is a way to measure, you know, how long it's going to take you, you know, how long you're going to be without that cash. So in your example, if I recall, you were like 30 days inventory, 90 days receivables, which is weird. I'm like, okay, cool. You know, maybe you contract with the federal government and it takes you 90 days to collect.
How did you know I sold missiles?
Yeah, exactly. Federal government actually buys everything.
I know. They buy some gnarly stuff.
Like everything.
It's pretty cool.
It is crazy. So, but so if I take that 30 plus the 90 in your hypothetical example that you gave, I'm 120 days without cash.
Right.
So for 4 months, what am I doing? You know,
Yeah, exactly.
What do I have? What does it cost me to run my business during that 4 months? And, you know, so if by the time I'm done with my overhead, my payroll, all these kinds of things, you know, let's say that I'm $50,000 a month to run my business, right? Well, then I need to have $200,000 of cash reserves.
Yeah, in cash, right?
Sitting there.
Yep,
you
exactly.
know? And it's like, whoa, that adds up pretty fast. And if I can
changes things.
If I can take that working capital cycle and reduce it down to 60 days, I only have to have $100,000 of cash reserve sitting there, which I just freed up $100,000 for my small business.
Exactly. You just became so much more nimble as a small business, so much more efficient, right?
Right.
And so these are, I honestly, I gave you so much grief about financial topics, but this is the kind of stuff that I love to learn about in small business, because these are the kinds of things that really, that they allow you as a small business owner to be one of the top business minds out there, right? Like your small business friends, if you know about this, your small business friends don't. You already have one up on them. Your competition that is that same way. So like, if you can understand these, if you can make your management decisions based on some of these things, you're winning.
Right.
Like not just in your field over your competition, but as a small business owner, as an entrepreneur, you could go out and apply this to a litany of different ventures and things.
Yeah.
You know what I mean?
Yeah. And so really, there's a lot of numbers. You know, this one's going to have a little bit of a grind to it, but
we need a whiteboard up here.
I know. Just we're gonna talk through it. It's not overly complicated, and you can do a search for the formulas if you need to. You know, if you want to see those formulas written out, it's not hard to find the actual formulas, and that's not. So we're gonna talk about the formulas,
really not.
but that's not what I care about. I care about the concepts here. That's what we're going to talk about. So we're going to talk about how to use the formulas, because, you know, in any software program, any trained monkey, you know, you can plug this into Excel and boom, you've got it.
Oh yeah. It's like going through any math class you did in high school or college. It's like, I'm never going to use this. Well, we're going to show you that you're going to use it. You can.
Yeah.
And it's awesome.
So, working capital cycle. Now, there are a couple things that we need to lay as a foundation for the working capital cycle before we can delve into it. And that is that we're going to be comparing the profit and loss with the balance sheet.
Right. You need both of those documents.
Both. And this is one of those things. So I can't tell you how many small business owners only use their P&L, another name for profit and loss. They only use their P&L and their balance sheet for tax purposes. And I'm like, dude, these are management tools. Like the whole recipe for success for your business is engraven upon these two stones, you know.
Okay,
I mean,
Moses.
Exactly. It's like right here, these stones.
You got to have a way better beard if you're going to be throwing down that roll.
I'm going to change my name from Ryan Murray to Ryan Moses.
That's legit. Ryan Moses Murray.
Yeah. But
I like it.
Everything that you need to know about your business is etched on these two financial statements. Here's the rule of financial statements. Garbage in, garbage out. Yeah. If you don't have accurate information on these financial statements to begin with, then doing these calculations is actually going to be more detrimental to your business, because if you're just taking a gut check. Now, I am not advocating gut check. I am saying do it right.
Ish.
No ish. Do
it right. But if you're not going to do it right, don't do it.
So
ish.
Honestly, yeah. If you're not going to do it right, don't do it. Do the gut check. But doing it wrong is detrimental, because now you've got a level of confidence that is completely false.
Right.
And I've seen that happen a lot, where businesses are like, oh yeah, I've got my P&L. And I'm just like,
I want to pause and talk about that for just 1 second, because, and I know we've talked about this before, but I think this is a really important time to reiterate this, is that, again, if you're only using these, or only pulling up this information and using these numbers and documents during tax time, And what do most people try to do during tax time, right?
Hide their money.
Exactly. And so if you're purposefully putting false information or skewing the information on these documents.
We like to say cooking the books.
Sure, whatever. If you're lying and cheating, I'm just kidding.
But no, even if you're
Everybody
just
does it, right?
mitigating your tax, burden,
Right.
This we're not talking criminal here. We're just saying,
Right.
oh, I'm going to write off all this stuff because I can.
Exactly.
And now all of a sudden it looks like I made no money.
Right. Exactly. So do you have 2 sets of books?
So some businesses will. That's actually a fairly common thing where
Interesting.
they will have their management books and then they will have their official tax books.
That's awesome.
And that's not a bad practice. If you think about some of the
I'm going
things.
to call my accountant.
Well, so for example, depreciation. Man,
Sure.
I love talking about a depreciation with accountants because they can never give you a straight answer. It's always like, well, I mean, we could depreciate that, but we could use the Marx formula or a straight line, and I'm gonna write it off this way. And then they kind of go off and I don't think I've ever had an accountant yet just tell me, yes, this is how I depreciate. It's always like, well, So
I'm pretty sure that this is like the part of the conversation where you're talking to your, oh gosh, I'm going to get in trouble. It's like you're talking to your wife on the phone and she's going off and you're just like, yeah, put the phone down. And you just carry on some other piece of business. You pick the phone up and you're like, right, yeah. Like that's exactly what just happened.
yeah.
Our listeners were like, okay, all right, Moses. Murray.
And so whoever's doing your books, you want to make sure that you're looking at the management set of books, that you're looking at the numbers that are really happening and getting as close to that.
Yeah.
I'll always say in finance, my statement is consistency is more important than accuracy. And again, every accountant that I've ever talked to, they get really mad at me when I say that. But I'm like, well, what happens when you find a mistake? Well, if it's organized correctly, I just move it into the right bucket. So you're telling me that if it's consistent, even if it's consistently wrong, you can easily fix it. But if it's inconsistent and right 80% of the time, but wrong 20% of the time, what happens? Oh, that's a mess because then I have to go through line by line and find all the errors. So consistency is more important than accuracy because it's easy to fix consistency.
Right.
So, be consistent with how you're going to use the management financials. Keep doing the same thing. Don't flip-flop quarter to quarter or year to year. Be like, well, we're going to try this time. It's like,
right.
No, be consistent,
Exactly.
right?
Always put them in the same bucket.
Right.
Those receipts.
Yeah. Yes.
I color code mine.
So
Primary colors.
So
keep it simple.
So when you're working with the working capital cycle, we need to look at the profit and loss statement. We need to look at the balance sheet. We're going to compare the two, and that's what's going to give us the calculation that we need. But we've got to have accurate, consistent financial statements to begin with. And so we're going to assume that that's where you are with your business, right?
Sure.
Now, anytime that you're comparing the P&L and the balance sheet, when you're taking a number from the profit and loss and you're taking a number from the balance sheet and you're coming up with a calculation comparing those two numbers, you're measuring the efficient use of money in your business.
Right.
And so, efficiency is the key word here. And I love it because so many people, they only look at that P&L side. I'll ask businesses all the time and they're just like, oh yeah, well, profits are up. I'm like, cool. What's your cash flow? I don't know.
Yeah.
You need to look at both. Okay.
For sure.
So the calculation is what we're getting into. We're going to start and we want to look at our sales on the profit and loss, and we're going to compare that to our receivables on the balance sheet. Okay. So I think it's easier to do an annual. I take a full year profit and loss. Now, keep in mind, the balance sheet is as of. So if I'm doing a full year and I'm on a calendar year, it would be as of December 31st. If you're on a fiscal year, it's the last day of your year, whatever format you're using.
Right.
It doesn't matter, right? And I'm going to take those sales and I'm going to divide my receivables into those sales. Because what I'm trying to figure out here is I'm trying to figure out how many days I am without that money because I've given terms. I've told them, hey, you know what? You're good to not pay me for the next 30 days.
90 days.
90 days.
I'm super generous.
120 days. 180 days.
People love doing business with me.
I bet they do. Is that why we don't make any money? Is because of your terms?
Aw. Ouch. It's always my fault.
So if I had, and I'm going to use some simple math here for a second, just to kind of keep things easy, right?
Thank you.
Okay. So if I had $100,000 in sales for the year, okay,
Sure.
and I had $10,000 in receivables on my balance sheet at the end of the year, I would take that $100,000, I would divide it by the $10,000, and it would tell me that I've got 10 turns.
Right.
And everyone's going to be like, I don't know what that means. So there's one more step that you have to do. You now take those 10 turns and you take 360. Why is it not 365? Because I guess the accountants decided that there's 90 days in a quarter and there are 4 quarters. So 90 times 4 is 360, not 365.
Sure.
That's the way they do it. Okay.
Perfect.
So I take my 360, I divide it by my 10 turns. My receivable turns is what it's called. How many times do the receivables turn in a year?
Right.
And I take the 360 divided by the 10, and I come up with 36.
Right.
So if I have sales of $100,000, receivables of $10,000, then I would be without my cash for 36 days because of my accounts receivables.
Right.
Super nerdy, but useful.
Right. Because then you can say, okay, I need this much cash to be able to get me through 36 days of business.
Exactly. The other thing that's really cool about this, because I've had a lot of people, they're just like, oh, well, we only offer 30-day terms. So 30 is our number. And I'm like, no, it's not.
Right.
Some people pay immediately. Some people take the discounts that you offer and pay within 10 days or 15 days or whatever discounts you offer. Some people, even though you say 30 days, they don't pay you in 30 days.
And you just happen to overlook it.
Yeah, because they're a big customer.
Exactly.
And so all of a sudden you're looking at it and you're like, oh, we do 30-day terms and my average is 42. Weird. That was weird.
Right.
And so the thing that's really cool about this is it takes the aggregate of all of your customers in a super simple calculation. I mean, I did that on the fly using a hypothetical, and it was easy to follow. And so you can take that and you could say, looking at that, it's going to give the aggregate of all of the receivables put together into a nice little bucket. And it's going to say, yeah, on average, it takes you 36 days to collect. And so if you're going to try and trim that down and you're going to try and say, well, the shorter I can make that, the better my cash flow is going to be, then you can start to look at the offenders and you can say, okay, who is not paying on time? Who is paying on time?
Right, because that's kind of the process that we want to go through here is first, the first level of it is understanding, right? Like we want to understand where we're at, how long it takes us for that cash to come back to us, and then you want to refine the process. You want to see how efficient you are first of all, and then take that and make it better. Right. That's the whole goal of small business.
Right.
And the better that you can make that, like you said, like if you can make that better and better, that just means that your business is more healthy and agile and efficient, and you have all that cash to put back into your company or to bonus employees or buy a yacht. I don't know, whatever. We can't buy a yacht.
Yeah, buy a yacht. That's clearly.
Why? I don't get why that's a thing.
To buy a yacht?
Yeah.
I've never worked with a business owner who's bought a yacht. We do live in a desert.
I do know a dude that sold his patents and bought a yacht, and he lives on a yacht. On a yacht.
That's cool.
I don't know if it is.
I think that's cool.
All right, fine. Anyway.
So the next calculation is the exact same concept, but we're just going to do it with inventory this time.
Okay.
So instead of taking the sales line, I'm going to take that cost of goods sold line off of the P&L, and I'm going to compare that to the inventory total off of the balance sheet. And I've had a lot of times where businesses are like, do I have a cost of goods sold? I'm like, if you have inventory, you have a cost of goods sold. If you
Right.
don't have inventory, you don't have a cost of goods sold. That's, oversimplifying it, but that's what it is, right?
Basically, yeah.
So using the same hypothetical business, I had $100,000 in sales. Let's say now that I've got $50,000 in cost of goods. Okay. So I've got my $50,000 in cost of goods. And again, doing simple math, I'm going to say that I've got 12.5 in inventory. So 50,000 divided by the 12.5, and that's going to give me 4. My inventory turns 4 times in a year. Well, that doesn't mean a whole lot to most people. And so we want to convert it to days. So what do? We take that 360 divided by 4, and it gives me 90 days.
Right.
And so now I'm at 90 days of inventory. I'm without cash so far 126 days.
Right.
That's that hypothetical example, but flip-flopped of what you were talking about earlier.
Exactly.
4 months without cash.
Yep.
So you're looking at it. What is a third of your operating expenses? That's what you have to have in the bank under this example.
Yeah.
It's like, ouch.
It's big.
It's huge. And one of the things that I want to talk about here is inventory and receivables are the two that just suck the cash.
Yeah.
And so if you're having cash flow problems,
Majorly. Take a look.
yeah,
For sure.
look at those 2 items first. Now, there are other things that, you can get way in over your head on labor. I see that one happen a lot. But inventory and receivables, they just suck it out. And some businesses, you have to offer extensive terms. I wasn't joking. If you want to do business with the government.
Yeah. Well, and I get that it's like kind of a ridiculous thing to be like, oh, we're going to offer 90 days for terms. But it totally depends on the type of business that you're in, right? Mm-hmm. All kinds of different business require all kinds of different setups and have all kinds of different working capital cycles. So
yeah. And so let's do one more.
Sure.
And this one is actually in our favor. So if we look at it and we say, okay, how long do we get vendor credit? How long do we have for our payables?
Right.
Because that's money that you've already purchased the inventory, but they're going to give you some time to pay on it.
Yeah.
Okay. And so I'm looking at this, and I'm again going to try and use some simple math here for a second. Okay. Sure. So if I take my cost of goods again, and I'm still using that 50,000 hypothetical number, so $50,000 cost of goods, and let's say that I've got payables of 10,000. Okay.
Sure.
So I would have payable turns of 5. The 50,000 divided by the 10 gives me 5. And then I want to convert that to days. So I take my 360 divided by 5. I'm doing this in my head, but I believe that's 72.
Sure. We'll go with that. I'm terrible at math in my head.
So I'm looking.
I'm
looking that I have 72 days to pay my bills. Now, these aren't very plausible numbers. Like I'm doing quick math in my head to kind of illustrate something. But for 72 days, I get to delay payment. So that actually is a negative on the calculation. So right now I'm at 126 days. 72 tells me that my total cash working capital cycle is 54 days. The 126 minus the 72, 54 days is what I'm looking at. So I need 2 months worth of cash.
Yeah.
And that's how you do it. And then you start looking at it and saying, okay, what is 2 months worth of cash in my business? Right. Do I have that much cash?
Yeah.
Most businesses don't, because they don't realize they need that much.
Right. Well, and I think a lot of businesses that I work with don't take advantage of terms. Like they think, oh, I got to pay. I want to be that guy that pays right on the spot. You know what I mean? Mm-hmm. And it's like, it's not necessarily a bad thing to take advantage of terms. Yeah. When they're extended to you for a reason.
And it's not a bad thing to ask for them.
Right.
If you're not getting them.
Right.
And
I mean, you can absolutely abuse terms, and we're not advocating that in any way, shape, or form, right? But if you have access to terms and you can use it to your favor while you're trying to work on leaning up your business and shortening your working capital cycle, if you need some of that stuff to work in your favor for a minute, by all means, use it. Mm-hmm. If you're using it to rob Peter to pay Paul,
And I'm glad you brought that up, because I've seen that happen
Yeah.
where people, they take advantage of terms and they're just like, oh, well, we don't have to pay on this. Or they start using it as kind of like quasi bank. And I'm just like, no.
That's bad territory to get into.
Don't be doing that,
Yeah.
you know. And so we covered a lot. And
Yeah.
honestly, it's pretty tricky, you know. Like, I'm sitting here saying, I'm going to do simple math, and people are just like, oh crap, I got it, you know. They're like listening to this on their mobile device while they're driving into work, trying to write things on the dashboard. I mean, I don't know, but
Dry erase marker on their windows.
but I really want to just go back to the concepts. And
Great.
the calculations don't matter. I mean, like I said, you can just pull up the calculations. They're easy to come by. They're not hard to do. That's not what I'm trying to emphasize here. I'm trying to emphasize that you need to know how much cash you need to operate your business. This is a tool to figure that out. If this tool isn't ideal for you, I don't care. Grab another tool. But it is so critical that you know how much cash you need to have in your business at any given time, and get that cash in there. And so that's like the big takeaway of this whole episode is know your cash.
Yeah.
Know your cash.
Make sure you have enough.
Yeah.
To fight another day.
Not to fight another day, to win another day.
Go to war.
Yeah.
I love it.
So with that, we're going to go ahead and wrap up. We appreciate you guys tuning in, and we will catch you next time.
Take care.